Hi everyone, this is Professor Gallagher. In Chapter 8, we're going to talk about the IRS tax provisions for rental properties, royalties, and income from flow-through entities. So we're going to start first with rental property. All income and expenses from rental property are going to be reported on a Schedule E, which the number at the end of the Schedule E will flow through to your 1099. All ordinary and necessary expenses that are related to a rental property are going to be deductible. An ordinary expense is any expense that is customary or usual for the rental property activity. Some examples of those types of expenses are advertising, repairs and maintenance, management fees, and depreciation. Speaking of depreciation, rental property is going to be depreciated using the straight line method of depreciation over 27.5 for residential property or 39 years for non-residential real estate property. The IRS depreciation tables are going to be used to calculate the depreciation amount. For rental property, we're going to depreciate the structure and furniture, which is 5-year property for the rentals, and the land will not be depreciable. The tables that we're going to use to calculate the depreciation for rental properties are the same as we used in Chapter 6 for businesses. If a taxpayer's rental property is considered a trade or business, if they are in a real estate profession, then the activity can be considered a trade or business, and the expenses and income are reported on the Schedule C instead of the Schedule E. Expenses that are paid by the tenant or services that are provided in lieu of rental payments are considered rental income. As such, the amount that must be reported to rental income and included on the tax return. So let's take a look at an example of that. Brady owns a rental property that he rents to his friend Jack for $800 per month. In November, Jack repairs a leaky roof for the rental property for $450 and pays Brady $350 for rent. So Brady is going to report $800 as rental income for the month and $450 for repairs and maintenance expenses in November, although he only received the $350 in cash from Brady. For rental vacation homes, they're treated a little differently by the IRS depending on what category it falls into. Property that's used for both personal use and rental activity will fall into one of these three categories as either primary rental, primary personal, or personal/rental. The three categories are determined based on the number of rental days compared to the number of personal days of use. For example, we have Jose, who owns a vacation home. He uses it over Christmas for 7 days, and he rents it to vacationers for 90 days. Those days determine the category of the property, as one of the three that were discussed on that last slide. So in this case, Jose's home is primary rental property because he only used it for 7 days out of the year, and he rented it to vacationers for 90. So the rule that applies to that is if it's personal use, it's used by the taxpayer or his or her family or non-family free of charge. In case of a family member, the use is considered personal even if that member pays fair market value. Time spent working on the property, if there's repairs being done, is not considered to be personal use. A rental property that's used no more than 14 days for personal purposes, or 10% of the total rental days, whichever is greater, is considered primary rental property. In that case, all income and expenses of the primary rental property are going to be reported on Schedule E. The expenses must be allocated between personal and rental use, and if a net loss results, the loss is allowed against other income up to $25,000. And this is also subject to the passive activity loss rules that we're going to discuss later in the course in Chapter 13. So to go back to that first example that we looked at, because Jose only used that rental property for 7 days it is considered a primary rental property. So it's the status of the property is based on the number of rental use days compared to the personal use days. Okay, so let's go back to where we were. So let's look at another example. We have Mandy who rented her home in Laguna Beach, California for 190 days for $36,000, and she used it personally for 17 days. So this will also be considered primarily rental property because 10% of 190 days is 19 days. So she can use it for up to 19 days and it still be categorized as primarily rental. So if we also, on the other hand, if we have a home that is rented for less than 15 days, but is otherwise used as a personal residence, it is considered a primarily personal property. All income derived from the short-term rental period does not have to be reported. Likewise, none of the expenses are deductible except those that are allowed as an itemized deduction on Schedule A, like your mortgage interest or property taxes. So for example, we have Maya who rented her cabin in Big Bear for $2,000 for 10 days over the holidays, and she and her family used it the rest of the year. So this would be considered primarily personal, and she rented it for less than 14 days, so she does not claim that income on her tax return or deduct any of the expenses. So this comes mostly into play too if we have cities where large events like Super Bowls are hosted, people can rent out their home for that weekend or the week of that event, and they earn that money tax-free. However, they can't deduct any of the expenses that are associated with that rental. So the next thing that we're going to look at is personal rental homes. If we have a rental property that is used more than 14 days for personal purposes, or 10% of the total rental days, whichever is greater, and is rented for 15 days or more, it is considered a personal rental property. All income and expenses are reported on Schedule E. The expenses must be allocated between the personal and the rental. However, the expenses are deductible only to the extent that there is rental income available. So with a personal/rental home categorization, we cannot deduct that up to $25,000 loss if there was a net loss on the rental. So let's look at an example. Adriana rented her lake house for 90 days for $13,500. She and her family used it for 50 days. So this would be categorized as personal rental property. Let's take a look at another example. We have Darren who rented his house at the lake for 48 days for $9,000 and stayed there on weekends with his family for a total of 18 days. During his stay, he worked to replace the roof for 6 days while his family went out on the boat and fished. How should this property be categorized? Well, we would categorize it as primarily rental because Darren's personal use days are only actually 12 days because even though he spent 18 days there, he spent 6 days working on the property by putting on the new roof. So those 6 days do not count as personal use days. So it would be classified as a primary rental because it was used for no more than 14 personal days for personal use, or 10% of the total rental days, whichever is greater. The rental expenses for vacation homes must be allocated between personal and rental use. This is true for both personal/rental property and primarily rental property. There are 2 methods available to be used to allocate those expenses. The IRS method, the allocation is based on the ratio of the number of days of rental use to the total number of days used. And the tax court method, the interest and taxes are allocated based on the ratio of the number of days of rental use to the number of days in the year, which is 365 days. The remaining expenses are allocated using the IRS method. So let's take a look at these two methods. We have a rental property that has the following expenses: $4,300 of mortgage interest, $2,300 of property taxes, $1,000 in repairs and maintenance, and $2,500 of depreciation. The rental income from the property was $6,300. The property was used for 22 days for personal use and was rented for 84 days. So this property is considered personal rental property, so we must allocate all of the expenses. So using the IRS method, the ratio for allocation would be 84 divided by 106. So this is the rental days divided by the total days of use. So we're going to use that for all expenses. So we have our rental income, the mortgage interest, again, it's going to be multiplied by our ratio. Property taxes, repairs and maintenance, and depreciation are all multiplied by the same ratio. So once we apply the ratio, the depreciation for the property is actually $1,981, but it's going to be limited due to the available income from the property. Since this is personal rental property, the amount that we're able to report on Schedule E would be 0, and we cannot have a net loss on a personal rental property. Now, if we use the tax court method, the allocation would be 84 divided by 365 for our interest and taxes, and 84 divided by 106 for all other expenses. The tax court allows 365 days for interest and taxes only, which gives us usually a higher overall deduction. The rental income, again, we have is $6,300. The mortgage interest, we're going to multiply that times 84 divided by 365. Property taxes, we're going to use the same ratio. For repairs and maintenance, we'll use the 84 divided by 106 for all other expenses, which is our repairs and maintenance and depreciation, which gives us net income of negative $2,008. So these amounts would be reported on the Schedule E. However, they are the amounts that are not deductible above for interest and taxes would still be deductible on Schedule A if the taxpayer is itemizing their deductions. So we have Jane and Richard. They own a vacation home. During the year, they rented the home for 75 days and used it for personal use for 30 days. We have the following income and expenses for the property. We have rental income of $15,000, mortgage interest of $6,000, property taxes of $1,400, insurance of $1,000, repairs and maintenance of $800, and depreciation of $2,000. So which of the three categories of vacation rental property would apply to this property? Well, due to their use of the home, they used it for 30 days and rented it for 75. This home would be categorized as personal rental property. Using the IRS method, how are we going to allocate these expenses? The expenses, we're going to take their total expenses for the property and multiply it by the rental days divided by the total number of use days to get 8,000. If we use the tax court method, which expenses would use the different ratio to calculate the expenses of the rental property? So our mortgage interest and property taxes would use the 75, the total rental days divided by the total number of the years, in allocating that expense.